You are no doubt familiar with the issue of going concern, which is an underlying fundamental concept in financial reporting. The way that transactions are accounted for depends upon this notion that the government or any other entity is going to be a going concern, that it will continue to exist going into the future. And if that's not true, if the entity that is doing the accounting and financial reporting is expected to not make it past the next year, or in the case of the governmental accounting standards, the next 15 months, uh, then uh, you know you would account for things differently, because you know that they're basically going to be liquidating everything, and there won't be a next set of financial statements. So the way you account for certain transactions will be different. Um, Governments are required to assess whether they are a going concern by looking at things like negative financial trends, defaulting on debt, not being able to borrow money, if there's some broader financial shock that has occurred. They need to consider whether they really are going to continue to be in operation. And generally, they will, the auditor will then look at that and they'll discuss it. Most of the time, obviously, this is not an issue. And if the auditor doesn't say anything about it and there are no disclosures about going concern, then you know that they concluded that the entity is in fact a going concern and that it's not an issue. But if they conclude that there may be some problems, that there may be some possibility that the government is not a going concern, then the government will make disclosures, and the auditor, you will see something about it in the auditor's opinion, but the government will disclose what it was that led the government to conclude that it might not be a going concern. If there's a possibility that the government is going to shut down and cease to operate and go away, some description of that, what their plan is for addressing the problems that led them to conclude that they were a going concern issue, and uh, some describe the ability of the government to hold on to its assets and to satisfy its liabilities when they come due. In some very severe cases, some governments who have going concerns may be filing for bankruptcy. You know, the thing is, governments don't go out of business very often. They do, but they're generally not general purpose governments like cities or counties. Sometimes governments will consolidate. One or more, two or more towns may, you know, merge into a single government. There are a lot of consolidated county and city governments, like Louisville, Kentucky, Miami and Dade County in Florida. Um, so a government's disappearing under those circumstances. But most of the time, the governments that disappear in a nature like that tend to be special districts that are doing just one single thing, and might get absorbed by a general purpose government, or simply just go out of business and stop providing whatever that service was. Um, and sometimes governments are expected to not last forever. Governmental entity is created to accomplish a particular task, and then once it does, it goes out of business as planned. But they happen very, very rarely. Maybe in any given year, 100 out of the 90,000 state and local governmental entities might go out of business. Um, so bankruptcy is a relevant issue for a lot of governments, because they're going to continue to exist, and that's what makes bankruptcy for governments different from bankruptcy for for a for-profit company. Is that for the for-profit company, what comes out of the other side of bankruptcy is not the same company. It's a reorganized company, and it may still be called whatever it was called before that, but it's not the same company. Uh, for governments, it's the same exact government. They're not going anywhere. They're not being restructured. So what Chapter 9 bankruptcy is focusing on for governments is restructuring their financial obligations. Um, it doesn't include state governments. They're sovereign entities in the U.S., as are tribal governments. So we're only talking about political subdivisions of states, and not every state allows it. Um, in fact, only 24 states have specifically authorized their localities to either file on their own or to seek the approval of the state to file. For instance, in Pennsylvania, they have the ability to file, but they need to get the state's approval in order to do it. And that was a big issue uh, for one government in particular, Harrisburg, where the state capital is. Uh, they wanted to file for bankruptcy, and the state didn't want to let them for a variety of reasons, not the least of which was the appearance of having the state capital, filing for bankruptcy, where the state legislature and the governor were located in the city that they're located in, they're not even taken care of. If a government, is allowed to file for bankruptcy, and in fact it does file for bankruptcy, and it receives a judgment uh, that makes changes to its obligations, the way it's accounted for depends upon what type of obligations we're talking about. So if we're talking about amounts payable or notes or debt obligations, either the bankruptcy will change the interest on that debt, or it will change the actual amounts uh, that are owed. And so, uh, this, I'm not going to get into the detail of the accounting for this, but essentially the accounting provides for how the amounts that are reported in the financial statements will change as a result. Um, an increasing focus of bankruptcy proceedings happens to be pensions and OPEB, because those do, for many, many governments, represent the biggest long-term obligations that they have. Um, if the plan of adjustment, that's the outcome of the bankruptcy proceedings, eliminates some of those pension or OPEB benefits, it's accounted for as if the government had terminated the benefit plan. There are already existing standards for dealing with that. So what the bankruptcy standards essentially say is, account for it the way it should be accounted for under the pension and OPEB standards. Sometimes the plan of adjustment may replace the existing pension and OPEB plans with a different amount, saying, well, you have to give this amount to the employees instead. That would be reported as a different liability, and in fact as a judgment, rather than as a pension or OPEB liability that would need to continue to be measured and disclosed under the pension and OPEB standards. Um, it's not typical that they would outright reject the entire post-employment benefit plan. The plan of adjustment may reduce the amount that is paid, and in that case, a government would account for it the same way it would account for any change in the terms of the benefit plan, under the existing pension and OPEB standards. Government should begin to make disclosures about bankruptcy proceedings as soon as they have filed a petition for bankruptcy, and it should continue until the fiscal year in which the case is closed or the bankruptcy petition is dismissed. Those disclosures include explaining what led the government to decide to file for bankruptcy and what the effects of those conditions and or events are likely to be on the government's finances. If it's possible, the government could in fact cease to exist or cease to operate, or if they actually have plans for shutting down the government, those should be a part of the disclosure as well. And then if there is a plan of adjustment, information about how to obtain a copy of that, or to state that it's not yet available, and provide an estimate of when they think the plan of adjustment will be available to the public. Subsequent events are things that happen after the end of the fiscal year, but that are significant in terms of their impact on the government's finances. And they come in two types, either recognized or unrecognized subsequent events. Recognized subsequent events that are things that actually took place prior to the end of the fiscal year that the government didn't become aware of until sometime after the end of the fiscal year. And therefore, they need to actually revise the numbers. And look, if it's something they become aware of before the financial statements go out, you probably don't even know about it, because it's just a part of the same, closing and auditing process. But sometimes it's something that they may not become aware of until after the financial statements have gone out, and so they do need to go back and restate the prior financial statements in order to address that subsequent event, its impact that they weren't aware of at the time. Most of the time, however, we're talking about unrecognized subsequent events. These are things that took place after the end of the fiscal year. So they didn't just become aware of it. It's something that actually happened after the end of the fiscal year. So you wouldn't make any change to the financial statements. But somebody who's looking at a government's financial statements often, on average, frankly, 6 months after the end of the fiscal year, when most governments get their financial statements out, a lot could have happened in that 6 months that would change your opinion about where they stood 6 months ago. And so, if a government is aware of something like that, it needs to disclose it, so that you can take it into consideration when you're looking at their finances. For instance, maybe some major law has changed in their state that will have an effect on their finances, on how much they can raise for property taxes, for instance. Or maybe it's a school district and the state has made a significant change to the school funding formula that will affect how much money that school district is getting from the state. Those are the types of subsequent events that you would expect to see disclosed in the notes to the financial statements. You would also expect to see that discussed in the final section of management's discussion and analysis, although you often don't see that type of discussion there, and that's because there are no subsequent events that are significant enough to be mentioned by the government. And so often that section of MD&A will talk about the following year's budget and about some economic and demographic data that's relevant, but they may not actually have some subsequent event to talk about. Governments operate, under the restraints of a lot of finance-related legal and contractual provisions. So things that are included in the transaction agreements that they enter into, laws and regulations that are imposed on them. And if a government has violated any of those, then they have to disclose the fact that they have violated them. So, for instance, many governments aren't allowed to run deficits in any of their funds. They may, if they exceed the amount that they appropriated for a particular activity or department or function, they've essentially violated the terms of the budget that they legally passed. If they have a technical default on a bond issuance, which means they haven't missed any payments, they haven't truly defaulted, but there are some provisions in the bond indenture, such as meeting certain levels of debt service coverage, and maybe they fell below that level, so they have a technical default, which could potentially trigger some requirement to put up collateral, or a requirement to put some money in a sinking fund to protect the bondholders. Then that constitutes a violation of a finance-related contractual provision that a government would need to disclose. They also need to disclose not only that they violated this requirement, but also what they're doing or what they did to resolve it. Almost exclusively up to this point in the course, we have talked about the ability side of financial health. And yet, if you go back to those definitions at the very beginning of the course of financial condition or economic condition, you will see that they tend to talk about ability and willingness. And up to this point, everything we've looked at really has focused on ability. You know, can the government raise uh, revenues? Can it raise taxes? Can it issue debt? Will it have enough money to meet its financial obligations as they come due? But we haven't talked about the willingness side of that. Because it's not enough for a government just to have, the ability to raise taxes or the ability to issue more debt, but there has to be some actual evidence that they're willing to use that ability. And in that case, we're talking about both the willingness of government officials to exercise it and the willingness of citizens to approve it, um, or what their attitudes are, even if their approval isn't required, what their attitudes are about raising taxes or issuing debt that might affect the government's ability. It's the government's willingness to employ that ability to do so. Um, so you might be looking at things like their record of raising taxes. So you look at that 10-year schedule of uh, uh, own source revenue rates might be a place you would look, and you'd want to look at rates of other revenues and other taxes as well over time to see how much they've changed. How willing is the government to increase those rates? Um, and Look at debt issuance. How often do they issue debt? Um, in terms of the willingness of citizens, you look at their voting records. Have there been ballot issues for tax increases? And have they succeeded? Have they passed, or have they been voted down? Have there been ballot issues for issuing debt? I'll give you an example from the state of New York. I don't think they've issued general obligation debt in like 35 years. And the reason for that is that uh, the state can't issue general obligation debt without voter approval, and voters just have not approved it, and so they don't even try it anymore. It has to have been something like 20 years since the last time there was a ballot measure in New York State for issuing general obligation debt, because they just know that the citizens in the state have no appetite for it. Of course, then that leads the state to enter into a lot of debt arrangements that are probably a lot more expensive than general obligation debt would have been. So they're circumventing the will of the public, but not necessarily for nefarious reasons. They're not pocketing those debt proceeds. They're using it to build needed infrastructure and to acquire other capital assets. But it ends up being more expensive than if the public had just approved the general obligation debt in the first place. Um, there are a lot of other qualitative issues as well that you need to think about that set the environment or context for the quantitative analysis that you're doing. What's the political atmosphere like? Is it trending more toward the fiscally conservative or more toward the fiscally liberal? How is that going to affect the likelihood of a government entering into transactions? What's happening at higher levels of government, at the state, at the federal government? And what are the implications for being able to count on them to assist a government if it's in financial difficulty? How is that going to affect future inflows of intergovernmental aid? Is the state government going through financial troubles of its own? Is the federal government going through financial troubles of its own that are likely to result in them saying, we're going to shift some of the burden onto you by reducing the amount of money we're giving your government? Headline risk is this issue of it's not something necessarily directly related to the finances, but it's something that's appearing in the paper, and now in this internet age where things go viral, uh, you know, things that you might call it reputation risk as well, things that are affecting how people view that governmental entity, and that may have an impact on its economics, on its finances, on the willingness of people to lend it money. If a government starts getting a reputation for being profligate, with its money, a bond a bond issuer, bondholders may be less willing to buy that government's bonds, or what is mostly the case, require them to pay more in interest in order to get them to buy those bonds. Um, those governments where uh, there have been highly publicized police shootings. Um, Probably most people aren't thinking about uh, the financial impact of that, but clearly, there are things, are big impacts on those governments, increased costs dealing with, uh, the inflow of people, into that governmental area, covering that story. It usually ends up increasing police costs, as ironic as that sounds. It may also have, some salutary effects in the way of, people who are, now providing, an economic boost by staying in hotels and eating in restaurants and stuff like that. But that's only temporary. And what will linger after the story dies is that sense that, that negative aura that is surrounding that governmental entity that may affect its, people being willing to live there or operate businesses there going forward in the future. Uh, One thing that we really won't focus on a lot in this course. It used to actually be an entirely separate lecture, but what is known as service efforts and accomplishments reporting, or performance reporting, uh, that gives you a sense of what a government is accomplishing in the provision of services, what the quality of those services are, is, a big deal. If you're looking at two governments that have identical finances, but one of them does a really good job of providing high quality services and the other one doesn't, I think you would generally conclude that the one that provides better services in the, in both the short term and long term, is going to be better off than the government that does a bad job of providing services, because the government with the good services is going to attract more residents, and it's going to attract more businesses, which will bring more tax revenue to that governmental entity. So performance reporting, or SEA, service efforts and accomplishments reporting, is devoted to uh, measuring how good a job a government does in reporting, in providing service. So, how well does it educate its students in elementary and secondary schools? How clean are the streets? What's the level of crime? How quickly do police and fire respond to 911 calls? How smooth are the streets, or how full of potholes, conversely, are they? Uh, these are examples of measures of the quality of service, of the outcomes. So not just that governments are spending money and staying within their budgets, and not violating uh, legal or contractual provisions, and not just repaying their debt when it comes due, but that they're using the money they've been given well. They're using it efficiently. They're using it effectively, and making that a good place to live. And that leads to this last item: quality of life. Uh, you know, Even things like climate could be relevant to your assessment of the financial health of the government. Uh, Two governments that are in, are identical in all ways, but one is in a really, beautiful area climate-wise, and one's not. And you're deciding which one's bonds to buy. You might want to buy the bonds. You might think more positively about the government that is in the warmer, sunnier climate. I know that may sound a little strange, but you're looking at that and saying, well, they may have opportunities that the other government doesn't have. They may not face some of the same costs of dealing with the climate that might, erode streets and bridges, and require capital investment to deal with, or the cost of clearing snow off the streets, or salting the streets in cold weather. They, of course, probably have other issues of their own, but is it a good place to live? Are people going to be attracted to move there? Are businesses going to be attracted to moving there? Those are things that are worth taking into account as well. They're not the primary focus of your analysis, obviously. The stuff that we've been talking to up to this time is, but then putting that all into some context and saying, okay, there are some other maybe more touchy-feely kinds of things that surround that financial analysis that we also need to take into account. Those are things that you want to be thinking about as well, although you don't want that to be the primary focus of your analysis. Obviously, saying, oh, well, this government's in good financial health because the average temperature year-round is 70 degrees. That would be fairly ridiculous. Um, but after doing all your analysis and being able to say, hey, this is a really nice area. It attracts people year-round for tourism because of the beautiful weather. That's a benefit. That's something we think will continue to provide resources to this government and make it a vibrant community. And that's a good contextual thing to consider as well. With that, that's the end of the lecture. Thank you.